is the Business Breakfast on the UAE's #1 talk radio station.
Dubai Eye 103.8.
Where we are this morning, taking a sneak early peek at the latest Property Monitor report, this one for December, their real estate index. Surprise, surprise, it is another strong month of growth. Very pleased to be joined by the Property Monitor COO and Cavendish Maxwell Director of Market Intelligence and Research, Jean Jahinki. Jean, good morning. Thanks for joining us.
Thank you. Happy Friday morning.
So we've got the strongest sales performance on record for December, but the pace of acceleration is slowing. Do you want to run us through those numbers and put them in context?
Yeah, so we're up about 1.7% month on month for December. So a nice growth rate. But if we look historically since the recovery, in 2021, annual growth was about 16%. And then annual growth for the full year last year was just above 11%. So that month on month growth rate is tapering off, which is a good thing that we want to see with the market. And we hope to see it going forward. We've now surpassed 2 years, more than 2 years since the market bottomed out and started to recover. The previous market cycle upswing only lasted for 2 years. So we've surpassed that. We've not reached the price point of the last market peak. So it's going slower and more steadily. So normally you'd expect market cycles, one after the other, to end up slightly higher than the last. So we could see the market go on. There's definitely room in the market. We could see another, say, 12 to 18 months of gentle price appreciation.
Where, you say we're not quite at that historical peak, where are we historically?
So we're about 15%, I think, now below that market peak. So there is some room to go in there. But again, markets don't always have to reach the last peak. Certain things can come in to slow them down, to abruptly stop them. The biggest one of those is supply. Most markets tip into that downward phase because of oversupply, or in the economic term in the market quadrants, hypersupply.
And where are we on the supply front?
Growing, but it's being absorbed, right? So there's that balance, supply and demand. We want to look at absorption. More and more properties come on the market. As long as they're being absorbed, being purchased, then we're in a good position. So we've got developers launching records amount of inventory. Last year, we saw about 53,000 new units come to the market. Most of those in the apartment segment, about 70%. And we've on pace to probably see that continue going into the new year. Developers are really back, and they're back with force.
So it's interesting. Quite a lot of this report is dedicated to that off-plan segment. And you've got questions not just about the amount coming to market, but about why people are buying it.
Yeah, so if we look back to where the market recovered, we know villa and townhouses, that's where the growth was. That's really dried up. And initially, a lot of the people that couldn't get those jumped into the off-plan segment buying villas and townhouses. Now we've got a lot of apartments coming in. And now what we're starting to see is people just not buying for end use, but investment. And the data's starting to point towards potentially some speculative activity.
What kind of data? What shows you that people are speculating? Is it actual flipping or more subdued than that?
So the first thing we can look at is off-plan resale. So an off-plan property, something that's not yet finished. If that changes hands a second time, so from a developer to a buyer and a buyer to a new buyer, a resale, that can be something that indicates that it's been a flip. Some people just might have gotten lucky and thought, you know what, I was buying this to live in, and then nice margin, they decide to cash out. That number's growing. We're at about 20% now. It's been steadily growing for the last 6 months. It's really hard to give you what sort of number is going to be a tipping point on it. When I go back and look historically, it's around about the 20 to 25% mark. But it can't be looked at in isolation. So I'm not saying it's at 20% now. I'll be scared there's too much speculative activity. But we need to watch that number and watch it grow.
Why is speculative activity, to play devil's advocate, why is it a bad thing?
Quick, easy money always comes with inherent risk, right? If you're looking to buy something, it's not going to be like years gone by where you buy it and 6 months later you flip it, right? Or even before that, you buy it, you walk down the line and you flip it onto someone for a profit.
We've got laws against that now.
There are things in place, not necessarily laws. Each developer has the right to impose their own things on there. I won't put names to the developers. One prominent one is at 50%. They raised it from 30% paid or 30% completed to 50%. 30% tends to be in most SPAs, but that's developer imposed. And a lot of time they're doing that to protect the market, but to also protect their market going forward. They don't want to be competing essentially with what they've sold. In general, it wouldn't be a bad idea to have an overall regulation that says X has to be done, say 50% completed or 50% paid, or maybe there's a higher transfer fee just to slow down that pure flipping activity. What we don't want to see a lot of flipping is it makes prices run away. It pushes them towards that escalating too quickly and bubble territory.
What are you hearing or seeing anecdotally or data-wise about the kind of margins that people are getting for this resale?
So if you look at, it depends when the project was launched. If you're looking at something that was launched pre-COVID, margins are pretty healthy, right? Take Talal Al Gaf, right? Timed perfectly in the market, their original phases, you're probably looking at a 30% premium. Nice and tight there. The later those phases went on, the premium is a little bit less and less as each phase. And it's pretty much the same over time. If you're buying 3 years ago, you're probably looking at that 30% premium or so. Now you're seeing some bought in the last 12 months, probably around the single-digit premiums there, maybe encroaching into the low teens.
Okay, we've got about a minute and a half left for you, so quickly, how much new inventory can we actually absorb?
It's a great question, right? Dubai has a lot of external influences that drive growth here. It's not just people that live here buying it. It's not just end users. It's people from all around the globe. And it seems that we're the net beneficiary of a lot of things with, if you think of the real estate market as a stream, and that stream has lots of taps that feed it, right? The Russia-Ukraine conflict fed that recently and is still feeding it. Lots of Russian buyers in the market, more than ever before. China was just turned on back in December, and there's other taps that could be turned on. We're already getting reports from developers that December activity to Chinese buyers has gone up exponentially.
30 seconds left with you. Rental yields. Where are we sitting at the moment, and what does that mean for why and how people are buying?
Yeah, so we're about 6.5%, 6.7%. They were last sort of quarter around 6.5%. They've just ticked up a little bit more. Those yields are likely to start to experience some pressure now as handovers start to happen. You've got a lot of inventory that's not just been sold, but coming to completion. As that comes on, more supply should drive prices down. But going forward, expect them to hold around that mid 6% range for the next year or so. There's not going to be enough supply to push them down dramatically.
Jean Jahenke is the Cavendish Maxwell Director of Market Intelligence and Research, as well as the Property Monitor COO, coming in with their December price index, looking at the strongest sales performance on record, but the pace of acceleration slowly dropping.